Well, I think that's what Wall Street is trying to figure out. Our economists did lower their third quarter GDP estimate from 7% down to 5.6%. Third quarter earnings are expected to be up 25%, but that's well below the near 90% gain that we saw in the second quarter. I think people are concerned about the Delta variant causing companies to delay their opening. And so on a month-to-date basis, meaning for all of September so far, the S&P is still in negative territory, off 1.3%. 10 of 11 sectors are in negative territory. And we're finding that 80% of the 147 sub-industries in the S&P 1500 are also in negative territory. So with the reduction in terms of the percent of sub-industries that are above their 50-day and 200-day moving averages, I would tend to say that today's action is more of a counter-trend rally within potentially a lower month. Well, I think that there's certainly the possibility of a meaningful decline. Every time I call for a correction, however, the market has fun proving me wrong, so I get tired of hearing myself cry wolf. But the S&P 500 has gone 3 times as long since we recovered from the last decline of 5% or more, meaning we've gone more than 300 days since the last decline of 5% or more versus an average of close to 100 days. So we are certainly due for one, and I think the resetting of the dials would be very helpful for the market overall. So if we do see that kind of a mild correction of 10 to 15%, I would tend to say that that would be a good buying opportunity because we do not see a recession nor a bear market down the road. Well, nobody who's going to be engaging in rotation should ever be 100% invested. I think that you always need to have some money on the sidelines to take advantage of unanticipated opportunities. But where we are seeing the weakest momentum right now are in the value groups such as industrials, such as materials. Also consumer discretionary has not been doing well on a relative basis. And those groups that essentially have the highest PE multiples are the ones that are likely to decline the furthest. So the defensive sectors would likely hold up best. But I think that those groups that end up being the weakest performers during the decline typically are those that have performed the best heading into that decline. So maybe investors might want to take advantage of some of the non-defensive areas and lighten up on some of that exposure. Long term for most investors is about 12 months, maybe 12 months to 24 months. So I would say yes, that energy could certainly be a market leader in the next year or two. It has been such a long-term underperformer that if you are a believer in reversion to the mean, this is a group that should do well, especially since it's already been beaten up and investors therefore are not looking to take profits in energy should we end up with a correction. Our belief is that energy in the upstream, meaning those closest to the well site, should do the best. We have the highest investment recommendations for the exploration and production companies, as well as equipment and services, because we're forecasting that energy prices will average around $73 per share. $73 per barrel for West Texas Intermediate oil in 2022. That up from the mid to low $60 per barrel in 2021. But if we do get enough of the COVID vaccines so that we have herd immunity, then we could find that consumers go out once again and really start to engage in activities that would be beneficial to the downstream or the refining and marketing using refined fuel, et cetera. So integrated companies would benefit from both ends, downstream and upstream. But right now, of the two, we think the upstream has the better opportunities.